Hello, I'm Piyush Dave, and today I'm going to talk about one more algo trading method called as a GARCH algo. Now, this method is very interesting method. It works with a logic of volatility. If the volatility increases, we are going to reduce the position size. That is a logic behind the total algo. Because if there is a wide movement, we may lose more in the capital, and if there is a calm movement, we may lose very small amount if the trade go against us. So the logic is trade on a bigger size if the volatility is low, and trade on smaller quantity if the volatility is high. So volatility will be calculated using this GARCH algo method, and it measures how wide movement can be in the future. So it is a very core mathematics because it is a predictive algorithm. So that's why the mathematics which has been involved in the GARCH algo is very complex. But I made it very simple with this tabular data. So first we will take this tabular data, and based on this tabular data, we are going to understand how the GARCH algorithm works, and then I'm going to show you in an actual simulation also. So for a base case, let's consider that the forecasted volatility of the market is 1%. So we are going to risk only 500 rupees, and we are going to trade only 50 shares. So that means a standard volatility, medium size trade we are going to take. Let's consider we have a capital of 1 lakh rupees, and we are going to risk only 500 rupees in the trade. So that's why the number of shares is 50 only. I kept the total risk involved in this is only 0.5%. If there is a market is highly volatile, the market is very wide, doing a 2% movement, double than the normal movement. Again, we are going to risk only 500 rupees. So that's why the total number of shares which we are going to trade is 25 shares only. Now this has reduced our exposure, and that is the main advantage on GARCH volatility. Now again coming to the lowest volatility, the main advantage of the lowest volatility is market is very calm. Again we are going to risk only 500 rupees from 1 lakh rupees. So the number of shares automatically increase because we have the lowest movement per share. See here 1% of the volatility is 10 rupees volatility. And if 2% probability volatility, that means 20 rupees volatility. If the volatility increases, we are going to lower the size of number of shares. And if the volatility is very calm, like here, 0.25% only volatility, we are going to increase our number of size of the shares. If there is a very high volatility, we are going to again reduce the size. You can see if there is a 4% movement in any share, it's considered to be extremely volatile. Now the question arises, how to forecast this volatility? So we understood, okay, for this kind of a volatility, we are going to trade very small amount. But the question is, how to find out this forecast, how to forecast this volatility? That is the main question. Now here comes algo called as a GARCH. Okay, now let me show you the exact calculation where the GARCH is going to calculate the future volatility. So our capital is around 1 lakh rupees here. We are going to risk only 500 rupees. And volatility is forecasted 1%. So that means we are going to trade 50 shares. The same calculation which I have shown in the table. Now this is a formula for GARCH and this is a main formula. So this is a return equal to PT minus PT1, PT minus 1 upon PT minus 1. Again, there's a innovation, shock, there's a shock equation, variance, and the volatility forecast. Now, observing this formula, you might find it's very difficult. But let me break this for you in the table itself. So you will understand each point. First part is what is the meaning of PT? PT is price at that particular time. Price at that particular time. Latest price, we can consider it as a latest price. So suppose the current price is 1000, the next price is 1010. So the current price is with the PT. RT is a simple return, the change in price. Okay, like we have for this case 1% return or 2% return minus 0.5% return. ET is shock or we can say surprise, the change, unexpected change. And we are increasing the magnitude of this shock also. That means if there's an epsilon square, we can say it's a strong move. Then we are going to find out variance. This will basically detect the volatility at that particular time, standard deviation, then omega, alpha and beta. So beta is a recent shock, past volatility, omega is variance. Okay, now let me break these all values for you in the table itself. So this is a very good option for volatility forecast. Slightly, there are multiple terms are there, so it looks difficult. But if you keep on working on certain values, then it's very easy. Okay, now the time is T0, T1, T2, T3, T4, like we have 6 cycle. For the first cycle, the price is 1000. For a second cycle, the price is suppose 1010. So what we are going to do, we are going to first find out what is RT. So let's check the formula of RT. So RT is PT minus PT1 upon PT1. So for this case, the calculation of this is 1000 minus 1000, 10 minus 1000 upon 1010. So it's coming out to be this value. Now square of this is ET square. So this is ET epsilon T square is square of this value. Similarly, again the price is decrease. So this is 1050 minus of 1010 upon 1010. So it is going to give me this negative value. Find the square of it. And we get 5 different value for 5 different cycles. Once we get this value, we are going to use this value as a first value. So once we start with ET1, so first value of this is this one. You can check out this value. I have just copy pasted here. So for the first case, we want the first cycle, and that first cycle we have to predict some value, or what we can say, we have to assume some value. So omega, we have taken omega as a constant value over here. Omega is always considered to be as, over here we have already given the value as 0.01%. Then the next term come out to be alpha. Alpha also is a fixed value, 0.05 to 0.01. Then we have the beta. Beta is also a fixed value, 0.8 to 0.9, past volatility. So that means alpha, beta and omega is fixed. We just need to take the previous value and the current value. Now the problem for the first case is we don't have the previous value. So here we are assuming the previous value. So this is our current value. And the previous value we have assumed the alpha is fixed, the beta is fixed. And we get the first reading. After we get the first reading, we are going to use this value in the further calculation. Okay, so sigma, from the sigma we are going to find out the root of sigma. So it predicts that there is a 1% volatility in the market. Again, sigma square next value. So this is the previous value, omega is constant. This value we have taken from here, sigma 1, and this value we have taken from here. Here the previous value was not available, so this is the assumption that the value is 0.001. Okay, once we get this value, we calculate and it comes out to be again 0.9%, that is 1%. Again, we will do it for sigma 2. This is omega. This is 0.1 is alpha. This value we have taken. This value we have taken from here. This value we have taken from here. And based on that, we again calculate the value. And here there is a 1% of it. So by iteration, we are going to calculate this. And you can see in all the 5 cycles, we are getting a volatility as 1%. So that means the future volatility will be on the 6th cycle, the volatility will be 1%. So this is a predicted one. So 5 cycle of analysis, and on the 6th cycle, we are predicting that value. Okay, now let me explain this one more time. So we are using RT, we are using ET square, then the sigma and the sigma root of sigma square. So volatility will be forecasted as sigma T. I want you to stop the video and take a screen capture of this so that you understand the core mathematics, how it has been calculated over here. First, RT will be calculated, ET will be calculated, ET square will be calculated, sigma T square will be calculated, and it will be done on iterative pattern. Like here, we have taken 5 different readings, and for all 5 different readings, RT is calculated. Now from RT, the ET is calculated. From ET, the sigma T is calculated. From sigma T, the sigma is calculated. And once we get all the sigma T for 5 iteration, the 6th part is a forecasting. So what it is saying, the GARCH volatility is saying, based on this calculation, based on this reading which we have taken over here, the change of the reading, is a 1% volatility possible. So if there's a 1% volatility, we are going to trade 50 shares. See, we have the capacity to trade 100 shares, but volatility is 1%. It's a normal market, so we are going to trade only half. If the volatility decreases, we are going to trade on our full length. If further decrease, we are going to increase more capacity. So this will help us to understand how much market is volatile, and GARCH basically forecast the number of shares to be traded based on the volatility, and it suggests what shares to be traded. Okay, now let me show you how it actually work in environment. So this is my exchange. Now exchange is continuously changing the price. Let me run this first. It keep on changing the price. I have no control over it. It continuously change the price. And the next, the mathematics which I basically explain, this is written in ALGO number 13. This is a file. And I'm taking the readings from the market. It is in a buffer mode currently. Buffer mode means it's collecting the price. Okay, we have the market over here and we have the ALGO over here. And you can see after the collection, it is on a candle number 3. It's called warm-up phase. So it's continuously calculating sigma square, then the change in sigma, previous sigma square and current sigma square. Okay, it's showing a balance trade. It's suggesting the number of unit to be traded. We have the highest capacity to trade around 100 shares, but it's showing, okay, don't trade for 100 shares. The volatility is suggesting two shares to basically trade on less number of shares. So currently we have normal volatility of 0.6%. Still we are in a warming phase and it's continuously suggesting, okay, how much trade to take. Okay, variance is been taken from previous value and continuous calculation is going on. The market is in a particular range. The volatility which has been forecasted by GARCH is 0.64. If this price change very wide, then only this units number will be changed. So you can see the number of unit has been increased because the volatility is going very down. Continuous we are getting the same volatility. Market is in particular range. So number of unit it's suggesting increases automatically if the volatility is going down. You can see the volatility is going down 0.58. Previously it was 0.67. So if the volatility decreases, the number of suggested unit automatically increases. If the volatility decreases, number of units increases. If the volatility increase, number of unit to be trade decreases. So this will help us to see the volatility increase, the number of suggested unit is automatically decrease. That's a beauty of this GARCH algorithm. This algorithm basically save us in trading higher volume in higher volatility. If the volatility increases, the number of unit automatically decreases. Currently, we are in a balanced state. Market is a balance, almost 0.7% of the forecasted part. So that's why it's showing almost to trade 80% of the cycle. I hope this is clear to you. Thank you very much.